Workhorse third quarter revenue fell short of analyst estimates. Also, its third quarter earnings fell short of analyst estimates. Now analysts are reducing future forecasts of the company. Let's look at this company a little closer to figure out whether they're a buy or a sell. Welcome to my channel. I'm Scott, and if you want to catch my newest video, I post one every day at 8 a.m. In this video, I am going to walk you through the process of valuing Workhorse's stock by analyzing its financial statements and dissecting its financial ratios, so we can determine if it's a buy or a sell. Workhorse manufactures electric delivery and utility vehicles. The company was founded in 1998. They were taken over by Navistar International, which had been selling them diesel engines. Navistar then closed the business in 2012 to cut costs after having suffered heavy losses. In March 2015, AMP Electric Vehicles took over Workhorse. Let's get started with the model. This is a mid-cap company, market cap $2.3 billion. They're trading at $19.22 a share, and there's 121 million shares outstanding. Let's look at the financials. The way you value a company is you forecast the future free cash flows, and then you discount that number back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. You can see this company has negative free cash flow every year. Net income is the profit and loss on the income statement. They also have negative net income every year. Their revenue doesn't look so great. It's $6 million in 2016, $11 million in 2017. In 2018, it's only $1 million. And it looks like it's zero in 2019, but that's just rounded because it's under $500,000. So their revenue looks terrible. The reason for the drop in sales from 2018 to 2019 was due to a strategic shift to the development of its C-Series vehicles. Below revenue is the cost of revenue. This is the cost directly associated to making the company's cars. So they have negative gross profit every year. They also, of course, have operating expenses, so they're even more negative, and then they have interest after paying their debt. So every year they're running at a negative. So obviously the company needs to sell a lot more vehicles to start turning some type of profit. This is the statement of cash flows. To calculate free cash flow, it's cash flow from operations, which is on top, minus capital expenditures. So every year, of course, they have negative free cash flow. So this company is bleeding cash. You can also see they're issuing more debt every year. It was zero in 2016, then 4.7 million in 2017, up to 18 million, up to 45 million. Let's look at a capital structure. They have $39 million of debt. On that last chart, it said they had 45 million of debt. They must have paid off 6 million. I pulled the 39 million from their 2019 balance sheet. And they have negative $35 million of equity, which means their liabilities are $35 million more than their assets, so they have negative equity. And their weighted average cost of capital is 10.48%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated terminal value, which is all cash flows past year for, that's 1.1 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $1.1 billion. We divide that by 121 million shares. And we get a calculated stock price of $9. They're trading at $19. So they're trading at a 120% premium. It's a sell according to the model. Simply Wall Street has them valued at $15.66. So they're also saying the stock is overvalued, just not as much as me. So I couldn't value this company using a regular discounted cash flow model because the value will come out negative. So I use as my base case what the average analyst projected the future free cash flows to be. Then I adjusted those future free cash flows based off of my analysis of the company's financials. So you could see the stock was really steady for several years, and it's been driven up recently because a lot of people going crazy for EV companies. It looks like the stock almost touched $30, but it looks like it was cut in half. It's come up a little the past few weeks. But I don't really see much value in this company unless they could, of course, make some sales. This company has never paid a dividend and doesn't plan on paying one in the future. It plans to reinvest all its earnings back into the business. Right now there's no earnings, but if it does have earnings, it does plan to reinvest that back into the business. If you invested $10,000 into this company 10 years ago, you'd have almost $300,000 today. When this company went public in 2010, it was trading as AMP electric vehicles on the OTC market. OTC stands for over the counter. It's for companies that do not meet the requirements to trade on a major stock exchange like the NASDAQ, which is what this company is currently trading on. A lot of companies that are trading OTC are usually trading under $1. As you can see, they were trading at 65 cents a share when they IPO'd. So far, the company has sold 360 electric vehicles. That's really nothing. Also, the company claims a single car will save over $170,000 in fuel and maintenance. Its customers are UPS, FedEx, and other businesses. Workhorse is one of 5 companies that may win a contract to develop 165,000 vehicles for the Postal Service. Workhorse did deliver 6 prototype vehicles to the post office, but this was originally mentioned over 3 years ago and the post office still hasn't made a decision. The company is focusing a lot of its marketing on the 300,000 last mile delivery trucks that are replaced annually. Last mile delivery is a term used in the trucking business. It refers to the final destination of the delivery truck. The final destination is usually someone's home. The goal of the last mile delivery is to get the items to someone's home as quick as possible while minimizing costs. Change is a California-based company, and they specialize in the last mile industry, and this company introduced its first electric vehicle in 2017. Let's look at their financial ratios. The average PE in the market is 14.9, the median is 14.8. PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. Since the company has negative net income, they have a negative PE. Average price to sales is 5.4, the median is 2.1. Price to sales is stock price over sales per share. To calculate sales per share, that's revenue over shares outstanding. And their ratio is 6,151, which of course is a lot worse than the median and average. The average price to book is 4.5, the median is 2.3. Price to book is stock price over book value per share. To calculate book value per share, that's equity over shares outstanding. They have negative equity, so they have a negative price to book. Equity is total assets minus total liabilities on the balance sheet. The average interest coverage ratio is 12.2. The median is 3.8. Interest coverage ratio is EBIT over interest expense. They're negative since they have negative EBIT. EBIT is earnings before interest and taxes. The average ROE is 11%, the median is 12%. ROE is net income over equity. They have negative net income and negative equity, so we can't look at this ratio. The average current ratio is 1.8, the median is 1.3. Current ratio is current assets over current liabilities. They cannot cover their current liabilities, so they probably need to take on more debt. Current assets are assets that can be liquidated into cash within 12 months. Examples are cash, accounts receivables, and inventory. Current liabilities are debts and payables due within 12 months. Examples are current debt and accounts payable. The best way to look at ratios is to compare them to similar companies. I've done videos on Ford, Lee, NIO, Tesla, and XPeng, all in the same industry as Workhorse. And if Workhorse has a number in red, they're worse than the average. So they're worse in every single category. Ford has the best ratio in 4 of the categories because they're the only company who has any profits. So to summarize, I have them trading at a 120% premium. Their ratios and financials look terrible. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking the link in the description below. Thanks for watching.